Imagine this. You wake up tomorrow and check your bank account. 7 digits stare back at you. $1 million. For a brief, euphoric moment, the world feels lighter. You imagine the debt-free life, the new car, the endless freedom. You picture yourself walking into your boss's office with a calm smile and saying, "I'm done." It's a fantasy millions share. The idea that once you hit $1 million, you've made it. You're rich, free, untouchable. But here's the truth no one wants to hear. $1 million today doesn't mean what it used to. And for most people, that realization comes far too late. Let's rewind a few decades. In 1980, $1 million could buy a sprawling suburban house, fund a comfortable retirement, and still leave enough for your kids' college. Back then, the median home price in the US was around $47,000. The average annual income was about $12,000. $1 million was equivalent to roughly 83 years of earnings for the average worker. But fast forward to today, and that same million buys you maybe an average home in California and a few years of breathing room. It's no longer a lifetime guarantee, it's a cushion, not a castle. The illusion of wealth has changed because the math has changed. Inflation doesn't sound scary in headlines. 3%, 4%, 6%, but those tiny percentages quietly eat your future alive. A dollar today buys only about a quarter of what it could in 1980. That means if your dream was to retire a millionaire, you'd need roughly $4 million just to live the same lifestyle your grandparents could afford with one. And yet, our brains haven't caught up. We still cling to the same mental milestone. If I just reach $1 million, I'll be fine. But here's where the misconception deepens. It's not just inflation that erodes the meaning of $1 million. It's how people use it. Most people treat their net worth like a finish line, not a system. They imagine hitting that number and exhaling forever. But wealth doesn't work like that. Money sitting still is money slowly dying. If you parked $1 million in cash today, earning nothing, it would lose nearly half its value in 20 years just from inflation alone. Even with a modest 3% inflation rate, that million turns into the purchasing power of about $553,000. Now, you might think, well, I'll invest it, and that's the right instinct. But even there, the math can be sobering. A conservative retirement withdrawal rate, the famous 4% rule, means you can safely spend around $40,000 per year from a $1 million portfolio without depleting it too fast. That's before taxes. That's before healthcare. That's before the random emergencies life throws at you. For many, $40,000 a year doesn't feel like freedom. It feels like a tighter version of what they already have. But the real danger isn't in the math, it's in the mindset. The myth of $1 million has become a psychological mirage. It feels like an endpoint, but it's really just a checkpoint. The people who build lasting wealth understand that the goal isn't a number, it's a system. It's how that number behaves, compounds, and protects itself over time. The rich don't celebrate hitting 7 digits. They focus on what that million does when they're asleep. Because in a world where costs rise, taxes bite, and longevity stretches decades longer than it used to, $1 million is no longer a destination. It's a vehicle that needs constant tuning. But let's pause and reflect on what this really means. Because underneath the math, there's a deeper emotional truth. Security is relative. In a culture that glorifies luxury, our definition of enough keeps moving. You can have $1 million and still feel poor if you're constantly comparing it to someone who has 5. The wealth illusion is a treadmill, one that quietly speeds up as your life expands. That's why so many millionaires still feel anxious, not liberated. They've hit the number, but they haven't escaped the psychology. Here's the irony. Most people chasing $1 million aren't after the money itself. They're chasing what they believe it represents. Freedom from worry, control over their time, the ability to choose. But money can't give you those things unless you design your life around how it works. Otherwise, you'll end up like countless people who reach that milestone only to realize they're still working, still stressed, and still dependent on the same fragile system they thought they were escaping. So, let's dig into why this shift happened and how to see the million-dollar dream for what it really is. Because if you can understand this, you can stop chasing old myths and start building something real. The root of this illusion lies in what psychologists call nominal thinking. We think in numbers, not purchasing power. A million sounds impressive, timeless even, because it's round, clean, symbolic. But wealth isn't about zeros, it's about what those zeros can do. The purchasing power of $1 million in 1990 is roughly equal to about $2.3 million today. So if you're working toward being a millionaire, you're actually aiming for half the buying power of your parents' dream. And the gap keeps widening. Look at housing, healthcare, and education, the three biggest costs in modern life. The median home price in the US now sits around $420,000. College tuition has more than tripled since 1990. Healthcare premiums for a family have risen over 200% since 1999. So when someone says they want to retire with $1 million, what they really mean, whether they realize it or not, is that they want to feel safe in a world that's getting more expensive by the year. But safety doesn't come from a number, it comes from understanding systems. Here's the system the wealthy understand. Money's power comes from velocity, not volume. It's not how much you have, but how efficiently it moves. $1 million sitting idle in a savings account earning 0.5% is less powerful than $500,000 moving intelligently through investments that generate 6% returns. In a decade, that $500,000 will outgrow the static million. That's why wealthy people don't think in terms of static wealth. They think in terms of yield. Let's visualize it. Imagine two friends, Lisa and Mark. Lisa saves diligently for 20 years and finally reaches her dream, $1 million in her savings account. She's proud, she's relieved, but she's also cautious. She doesn't want to lose it, so she keeps it safe in a low-interest account earning barely anything. Mark, on the other hand, has $400,000 invested in dividend-paying stocks and short-term treasuries. His money isn't as big, but it's working. It generates $24,000 a year in passive income without him doing anything. Meanwhile, Lisa's $1 million earns her maybe $5,000 in interest, less than half the income with more stress. After 10 years, inflation cuts her purchasing power nearly in half. Mark's investments, however, have grown to $650,000 through reinvested returns. Who's wealthier now? That's the hidden trap of the millionaire myth. It confuses accumulation with motion. The rich don't accumulate and stop, they circulate and grow. Money that moves intelligently multiplies. Money that hides decays. But here's the twist most people miss. The problem isn't that $1 million isn't enough. It's that it's not designed to work in the way most people imagine. If you think $1 million will buy you freedom, you've mistaken the tool for the trade. The true path to financial independence isn't crossing a finish line. It's building a system that keeps moving without you. Let's dig deeper into the emotional illusion behind that number. Because the myth of $1 million doesn't just distort how we plan our finances, it shapes how we think about success itself. When you hear millionaire, you instantly imagine luxury. Sleek cars, designer homes, vacations in places with turquoise water. But most millionaires today look nothing like that. In fact, according to studies by Fidelity and Schwab, the average US millionaire drives a 5-year-old car, shops at regular grocery stores, and works full-time. They're not living the cinematic dream. They're just financially steady. The problem is, social media has rewired our expectations so dramatically that even stability now feels small. We scroll through feeds flooded with private jets, passive income gurus, and 20-somethings flaunting Lamborghinis they don't own. It tricks your brain into believing that everyone else is doing better, that you're behind. That illusion makes people chase bigger numbers without understanding the structure behind them. They want $1 million, but they ignore the math of maintenance. Because here's the truth, being a millionaire isn't a finish line, it's a responsibility. If you own $1 million in assets, you've basically built a small business. That business has revenue, your returns, expenses, taxes, inflation, risk, and management, your decisions. Treat it passively, and it collapses. Treat it systematically, and it compounds. But most people who finally make it don't build systems. They build lifestyles. They upgrade everything: houses, cars, habits, expectations. And that's when the silent killer shows up: lifestyle inflation. Lifestyle inflation is the invisible leak in almost every financial bucket. You start earning more, so you start spending more. You justify it as rewarding yourself, and in moderation. That's fine. But the problem is, every new upgrade becomes the new normal. The car that once felt luxurious feels average a year later. The home that felt spacious starts to feel cramped. You keep chasing satisfaction that keeps moving further away. Before long, your million doesn't feel like wealth, it feels like survival. This is why most lottery winners go broke, and many high-income earners stay stressed. Because when the number grows, but the mindset doesn't, the equation still ends the same way. Wealth without structure is chaos with better packaging. But the people who stay rich, or get richer, view money differently. They see $1 million not as a trophy, but as a machine. They think in terms of flow, not accumulation. Every dollar has a job. Some dollars are sent to earn more investments. Some are sent to protect what already exists, insurance, reserves, and some are used to buy back time, delegation, automation. They understand that freedom isn't about how much you own, it's about how much you can stop worrying. Let's look at what that means in real terms. Suppose you have $1 million and live off the 4% rule. That's $40,000 per year. In most major US cities, that's not luxury. That's survival with a small margin of comfort. Rent, healthcare, and groceries alone can eat up half that number. Now add taxes and emergencies, and suddenly your dream feels fragile. If you want true peace, where your lifestyle doesn't depend on the next paycheck or market swing, you'd need at least double or triple that amount. That's not pessimism, that's math. But here's where the mindset shift begins. Instead of asking, how do I make $1 million? Start asking, how do I make $1 million behave like $5 million? Because that question focuses on systems, not symbols. It shifts you from chasing the number to designing the structure. For example, a person with $1 million in rental properties, generating 8% net return, is effectively earning $80,000 a year. Another person with $1 million sitting in cash is losing purchasing power daily. Same number, opposite outcomes. The first person designed their money to move. The second person designed it to disappear slowly. And this doesn't apply only to investing. It applies to your entire lifestyle design. Because even if you don't have $1 million yet, the principles that protect it are the same ones that build it. Spend less than you earn. Invest consistently, and let compounding do the heavy lifting. But the biggest difference between those who reach financial independence and those who don't isn't discipline, it's patience. Patience is the one trait money respects more than intelligence. Compounding doesn't reward speed, it rewards duration. A dollar doubled once becomes $2. A dollar doubled 10 times becomes 1,000. The difference isn't genius, it's time. That's why wealthy people don't obsess over quick wins. They obsess over endurance. They design systems that let time do what hustle can't. But let's step back for a second and ask something more philosophical. If $1 million doesn't buy freedom anymore, what does? What does enough look like in a world where the goalposts keep moving? The answer isn't a fixed number, it's a fixed mindset. Enough is the point where your lifestyle matches your values, not your vanity. For some, that might be $500,000. For others, it might be $5 million. The number changes, but the principle doesn't. Freedom comes when money stops controlling your mood. That's the part no spreadsheet can measure. Because even if inflation doubled tomorrow, even if the cost of living skyrocketed, the people who understand how to adapt, how to live intentionally and build systems that protect their time, will always feel wealthier than those who don't. The truth is, we're not chasing millions for luxury anymore. We're chasing it for margin, the space between survival and serenity, the space where you can take a breath, make decisions calmly, and live without fear. And that's something you can start building long before you ever hit 7 figures. Here's where the deeper realization begins. Wealth is no longer about the size of your bank account. It's about the strength of your system. $1 million without strategy is just an expensive illusion, but a structured financial system, even with modest income, is what creates longevity. The truth is, most people who reach $1 million never ask the second question: how do I keep it? Let's look at the numbers for a moment. If you earn a 5% return on $1 million, that's $50,000 a year before taxes. But if inflation runs at 3%, your real return is closer to $20,000. That's less than the average US household spends annually on housing alone. Now add rising healthcare costs, travel, insurance, and the simple desire to enjoy your life, and suddenly your million starts to shrink faster than you expected. This is why so many retirees feel financially insecure despite being millionaires. They underestimated time. Time is the most underestimated cost in personal finance, because we don't just live longer, we live more expensively. People in 1950 retired at 65 and lived to 70. Today, many retire at 65 and live to 90. That's 25 years of drawing down your wealth, not 5. And if you think Social Security will bridge that gap, think again. The average Social Security benefit is around $1,900 a month, not even enough to cover rent in many US cities. So that million you thought would buy peace, it has to stretch across 3 decades, rising costs, and the psychological stress of uncertainty. But the wealthy don't panic about this, because they think in systems, not snapshots. Their question isn't, how much do I have? It's, how many sources of income have I built? They understand that resilience comes from diversification, not digits. They build a mix of cash flow, capital gains, and tax efficiency, like pillars holding up a bridge. That's how they turn static numbers into dynamic security. Here's an example. Imagine you had $1 million divided like this: $400,000 in index funds, $300,000 in real estate, $200,000 in short-term treasuries or bonds, and $100,000 in cash reserves. That portfolio isn't flashy, but it's balanced. It earns, it protects, it moves. Your returns aren't explosive, but your risks are minimal. You can draw $50,000 to $60,000 annually while your base grows. That's how real millionaires think, not as gamblers, but as architects. Because at its core, wealth isn't about growth. It's about design. The design of your habits, the design of your spending, the design of your time. And this is where the emotional shift happens. When you realize the modern definition of wealth is no longer how much can I buy, but how long can I stay calm? True wealth isn't being able to buy anything. It's being able to ignore everything. The calm that comes from structure is worth more than any lifestyle upgrade. But here's the tragedy. Most people will never feel that calm, even when they have the money, because they mistake motion for progress. They chase investments they don't understand, buy things they don't need, and live in houses they can't afford, all to prove something to people who aren't even watching. They reach $1 million on paper, but feel poorer than ever inside. What most people don't realize is that wealth without peace is just a different kind of poverty. The anxiety never leaves. It just wears nicer clothes. That's why the smartest investors build what I call a psychological portfolio. It's not just assets, it's awareness. They diversify not just across asset classes, but across emotions. They know when to risk, when to wait, when to stop. They don't measure wealth by the number of zeros in their account, but by how much of their day is spent in control of their time. Because here's the truth, you don't need $1 million to be wealthy. You just need enough systems in place that your income exceeds your expenses without your effort. That's the real definition of freedom. And freedom scales differently for everyone. For one person, it's $3,000 a month in passive income. For another, it's $10,000. But the principle is identical. Wealth is what keeps working when you stop. Let's ground this in an example. Suppose you built a simple 3-layer financial system. A safety layer, 6 months of expenses in a high-yield account. A growth layer, consistent investments in index funds or ETFs. A freedom layer, assets that generate cash flow, like real estate or dividend stocks. You don't need $1 million to start this system. You just need momentum, because momentum, once established, compounds faster than any investment return. Each decision to automate savings, reinvest dividends, or live below your means multiplies over time. And that's where the perspective shift becomes profound. $1 million isn't the goal. The goal is what that million represents: margin. Margin is the difference between chaos and control, between reacting to life and designing it. When you finally build that margin, whether at $100,000, $1 million, or $10 million, your relationship with money transforms. You stop seeing it as something to chase and start seeing it as something to steward. You begin to understand that the purpose of money isn't to make life louder, it's to make life quieter. That's why, even though $1 million isn't what it used to be, its lesson is still timeless. The lesson is that money loses meaning when it isn't guided by intention. Inflation can shrink its value, but only you decide its purpose. So maybe the real question isn't, why isn't $1 million enough? Maybe it's, what would enough look like if you stopped comparing? Because wealth is relative, not to others, but to yourself. $1 million today can still change a life, but only if you treat it like a system, not a symbol. Only if you use it to buy time, not things. Only if you let it serve your peace, not your ego. Because in the end, the richest people aren't the ones with the most money. They're the ones who've made peace with what they already have and learned how to let it grow quietly, instead of loudly proving it. The meaning of $1 million may have changed, but the principle of wealth never has. True wealth has always been this: control, calm, and continuity.